Step 5. Recognize revenue. In Step 5 of IFRS 15, revenue is recognized based on specific conditions, which can vary depending on the nature of the performance obligations and the terms of the contract. These conditions ensure that revenue is recognized accurately and in accordance with international accounting standards. Condition 1. Continuous transfer of control. This condition applies when the customer simultaneously receives and consumes the benefits of the entity's performance. As the entity performs, control over the asset is transferred continuously. Example: XYZ Software provides a cloud-based software subscription. Revenue is recognized monthly because the customer continuously benefits from the software access and updates. Condition 2. Performance creates or enhances an asset. Revenue is recognized over time when the entity's performance creates or enhances an asset that the customer controls as the work progresses. This reflects scenarios where the entity's performance is tied to the creation or enhancement of a customer-controlled asset. Example: ABC Machinery manufactures custom machinery for a customer. Revenue is recognized over time because, as ABC Machinery constructs the machinery, it enhances an asset that the customer controls. Condition 3. Entity's performance does not create an asset with an alternative use. Revenue is recognized over time when the entity's performance does not create an asset with an alternative use, and the entity has an enforceable right to payment for performance completed to date. This condition is relevant when the entity's performance is not creating an asset with alternative uses for the customer. Example: ABC Software provides a software as a service (SaaS) subscription. Revenue is recognized over time because the software is hosted on ABC's servers, and the customer has no alternative use for the software beyond accessing it from ABC's servers. ABC has an enforceable right to payment as services are provided. Point-in-time control transfer. Revenue is recognized at a specific point in time when none of the conditions for recognizing revenue over time are met. This typically occurs upon delivery or when the customer obtains control of the asset. Example: XYZ Electronics sells a standard smartphone to a customer. The smartphone is readily available and does not involve any customization. None of the previous conditions for recognizing revenue over time, such as continuous transfer of control or performance creating or enhancing an asset, apply in this scenario. In this case, revenue is recognized at the point in time when the customer takes physical possession of the smartphone, which is typically upon delivery. The customer obtains full control and benefits from the smartphone immediately upon receiving it, and therefore, revenue is recognized at that specific point in time.